Quick disclaimer, tax laws vary by country and change frequently. What I'm sharing are general strategies. Check what applies in your country and consult a qualified tax professional for your situation. Now let's talk about something everyone cares about, but few people truly understand: taxes. If you're watching a chunk of your paycheck disappear every month and wondering if there's a legal way to keep more of what you earn, you're in the right place. Let's start from the absolute basics. Income tax. Income tax is what you pay to the government based on how much you earn. You don't pay the same tax rate on all your income. Most countries use a progressive tax system. This means your income is divided into brackets, and each bracket is taxed at a different rate. For example, let's say you earn $50,000 a year. You don't pay 22% on all $50,000. Instead, you pay 10% on the first $10,000 equals $1,000. You pay 12% on the next $30,000 equals $3,600. You pay 22% on the final $10,000 equals $2,200. Total tax $6,800. Your effective tax rate is 13.6%, much lower than that 22% bracket you're in. What about pay rises? If you get a $5,000 raise, bringing you to $55,000, only that extra $5,000 gets taxed at 22%. That's $1,100 in taxes, meaning you keep $3,900. You're always better off earning more, even if a bigger percentage goes to taxes. Check your country's specific tax brackets. They vary significantly. What are the strategies you can use to reduce your tax? Strategy 1. Pension contributions. The most powerful tool for reducing taxes is pension contributions. When you contribute to a pension, that money is often deducted from your income before taxes are calculated. This lowers your taxable income, which means you pay less tax now. Example, you earn $60,000 a year and you're in the 22% tax bracket. If you contribute $5,000 to your pension, your taxable income drops to $55,000. You save $1,100 in taxes, 22% of $5,000. That $5,000 you put away only cost you $3,900 because you saved $1,100 in taxes. That's like getting a 28% return instantly, just from the tax savings. What happens when you retire? You'll pay taxes when you withdraw the money. But here's the advantage. Most people are in a lower tax bracket in retirement than during their working years. So you save tax at 22% now and pay tax at maybe 12% later. That's a significant win. Plus, your pension investments grow tax-free in the meantime, which means compound growth on money that would have otherwise gone to the government. In some countries, you can borrow against your pension account, though there are usually strict rules and potential penalties. This isn't generally recommended except for emergencies, but it's worth knowing it's an option. Strategy 2. Earning through a company vs. as an individual. This is where you can potentially save the most money. When you work as an employee for a company, you pay income tax on your salary. But when you work as a self-employed individual, a sole proprietor or freelancer, you pay both income tax and self-employment tax, which covers Social Security and Medicare, or equivalent in your country. Self-employment tax typically adds around 15.3% on top of your income tax. That's a massive extra burden. So instead of working as a self-employed individual, you can set up your own company and work as an employee of that company. For example, you make $100,000 as a freelancer. As a sole proprietor, you'd pay income tax plus 15.3% self-employment tax on the full $100,000. That's roughly $15,300 in self-employment tax alone before even calculating income tax. As an S-Corp owner, you could pay yourself a reasonable salary of $60,000, which gets full taxes, including self-employment tax, and take $40,000 as distributions, which only get income tax, no self-employment tax. You'd save roughly $6,000 in self-employment taxes just on that $40,000 in distributions. You're still working for yourself, you're just structuring it differently. You own the company, you control the company, but you're technically an employee of your own company. This gives you the best of both worlds, complete control over your work and significant tax advantages. Check your country, rules vary enormously. In the US, S-Corps and LLCs work this way. In the UK, limited companies offer similar benefits. In other countries, the structures and tax benefits differ significantly. You absolutely need local tax advice before doing this. Strategy 3. Tax advantaged investment accounts. Beyond pensions, many countries offer special investment accounts where your money grows tax-free or tax-deferred. These are powerful tools the government provides to encourage specific types of saving. Examples include health savings accounts, HSAs, available in some countries for healthcare expenses. Triple tax benefit, contributions reduce your taxable income. Growth is tax-free and withdrawals for medical expenses are tax-free. That's 3 separate tax advantages in one account. Education savings accounts, for saving for your children's education. Contributions may be tax deductible depending on your location. Growth is tax-free, and withdrawals for qualified education expenses are tax-free. Roth IRAs, or equivalent, retirement accounts where you pay tax now but never again. You contribute after-tax money, but all growth is tax-free, and all withdrawals in retirement are completely tax-free. If you invest $10,000 that grows to $100,000 over decades, you never pay tax on that $90,000 gain. The key strategy: max out these accounts before investing in regular taxable accounts. The tax savings compound dramatically over decades. Strategy 4. Investment income and other tips. Not all income is taxed equally, and understanding this can save you serious money. Long-term capital gains. If you hold an investment for more than a year before selling, you typically pay long-term capital gains tax, which is often 0%, 15%, or 20%, much lower than ordinary income tax rates that can go up to 37% or higher. For example, let's say you make $10,000 from investments. Short-term capital gains held less than a year, a 22% ordinary income rate equals $2,200 in taxes. Long-term capital gains held over a year at 15% equals $1,500 in taxes. You save $700 just by holding the investment longer. Another strategy is to know: charitable giving. Donations to qualified charities can be deducted from your taxable income if you itemize deductions. Giving $5,000 to charity in the 22% bracket saves you $1,100 in taxes. Legally reducing your taxes isn't about dodging your responsibilities. It's about understanding and using the tools the government has intentionally created to encourage retirement savings, business investment, healthcare savings, and education. Every country has different rules. Every situation is unique. Work with a qualified tax professional in your country who understands your specific circumstances. If this helped you understand taxes better, hit that subscribe button for more practical financial content. Drop your biggest tax question in the comments below. Thanks for watching.